This chapter, we're going to talk about loans, both business and consumer loans. The first section deals with credit cards. So credit cards are not necessarily loans, but you're given a set limit that you can spend up to, and then you're going to pay interest on that limit if you don't pay it off over time. So if you've had a credit card, and again, businesses have credit cards, individuals have credit cards. You receive a monthly statement that shows you all of your charges listed out by date. Your charges are debits to the account, they're increasing the amount you owe. Any payments you make or returns that you have made on that credit card are going to be credits, they're going to reduce the balance that you owe. So we go through, and again, this would all be done from a computerized standpoint in some sort of a software program. But we're going to go through it line by line and do the math just so you understand how this average daily balance is calculated. And you might think, well, why do I care about how this average daily balance is calculated? It's because that's the balance that the bank is allowed to charge you finance charges on if you do not pay your balance in full. So sometimes people do not, and the bank is charging us interest. So we want to make sure that it's being done properly. So what we'll do is we're going to go through the mathematics of it, and I almost like set up a little table where you say, okay, what's my billing date? What's my transaction on that day? What does that make my balance become? So then that's what I have here, take the balance. Then you're going to make that balance, you're going to take that balance and you're going to multiply it by the days outstanding. And then how do I calculate the days outstanding? You go from your current transaction to your next transaction. So then, and again, you can mostly, those are pretty easy just to subtract those. So like if you go from the 10th to the 12th, it's 2 days. The 12th to the 16th would be 4 days. But you're always looking ahead. So those days outstanding is your current transaction to your next transaction. And then you're going to go through that line by line. So the date, the transaction amount, what does that make, what does that bring your balance up to? Multiply by your days outstanding from the current transaction to the next, and then calculate out a total. Then we're going to add we're going to do that for every line item on our statement. We're going to add that total up and divide it by the number of days. Now, when you add up your number of days, you always want to tie that back out to the month. So like if our credit card statement starts on January 10th and goes to February 10th, since January has 31 days, we would want to make sure our total days are 31. Then we'll calculate that average. So then when we take that total and we divide it by the number of days in the billing cycle, we'll calculate out that average balance. Then that average balance times the percentage that the bank is charging us gives us our finance charge. And then we add that to our ending balance to figure out how much we actually owe the bank. So again, look in your book for examples or in my notes and my in-class exercises, because again, I kind of set up like a nice little table to do that. Then the next section, we talk about loans, or the next couple sections. So there's some different terminology. Our total installment costs is the total cash out of our pocket when we enter into a loan with a bank. So we're more than likely going to have a down payment, and then we're going to have monthly payments times our number of months. So that's how much in total we pay for that loan, and the textbook calls that our total installment costs. How much do we finance is our purchase price minus our down payment. That's our financed amount. And then we're going to amortize that loan. So we're going to take each monthly payment and break it down to say, well, how much goes to interest and how much reduces our balance. So the amount that goes to our principal is the amount that reduces our balance. And then a lot of times in the homework, they'll ask us to calculate our annual percentage rate. So we're going to go back again and use our time value of money keys, and we'll compute the IY. But what you want to remember is that when you compute the IY, it very well is going to give you a monthly rate if this is a monthly loan. So you got to take one more step, multiply it by 12 to turn it into an annual percentage rate, because they're always going to want the annual percentage rate. So in these sections, again, we deal with installment loans, personal property loans, and real estate loans. So all of them are set up the same way using our financial calculators. So our N is going to be our number of monthly payments in the loan. Our IY is going to be our rate per month, the annual rate divided by 12. The present value is the amount borrowed. So again, go back to that prior slide, but it's the purchase price minus the down payment. So that is what our amount, that is what our present value will be, the amount borrowed. And then the future value of a loan is always, always zero. So you never have to read these and think, gee, I wonder what I put in my present value and I wonder what I put in my future value. The present value is always the amount we borrowed today. The future value is always zero because it should be paid off. And then we're computing the payment. Now, if they give us the payment, maybe sometimes they do, then we're going to be computing the IY. Now, when I have the present value in the payment, I make the present value negative. Now, then they'll ask us to amortize that payment. So like I said a couple slides ago, anytime we're dealing with these loans, it's an amortized loan, which means we pay principal and interest as we go. So the calculator does that work for us and takes all of the math out. Our first step is always to compute the payment using our time value money keys. Then we hit the second menu and the PV button, and that takes us into our amortization function. Inside that amortization function, we will only enter P1 and P2. The balance of the loan is going to pop up, the principal of that payment is going to pop up, and the interest of that payment is going to pop up. So you just have to make sure that you enter the P1 and the P2 properly. If we want to isolate one payment at a time, actually build an amortization schedule, you're going to make your P1 equal to 1 and your P2 equal to 1. And when you enter the 1 in there, you always have to hit the enter button. So notice at the top, we can enter numbers, we can arrow up or arrow down. We always want to enter as we put in our P1 and our P2. Then if we want to move on to payment 2, we make our P1 equal to 2 and our P2 equal to 2. And again, it'll display the balance, the principal, and the interest. If we want to look at payment 3, we make our P1 equal to 3 and our P2 equal to 3. The only time we ever have those not equal is, say it asked us a range. Say it said, how much interest did you pay in the first year? Then you'd want your P1 to be 1 and your P2 to be 12. That gives you a range of time. But if we're just building the table or the schedule, just do one payment at a time, isolate one payment at a time. So here shows you kind of inside those screens. So again, if we had a $15,000 loan, 3 years at 12%, the first step is to find the payment. So 36 months is our N, 1 is our IY, that's our rate per month. We borrowed $15,000, the loan is paid off at the end. We have a $498 monthly payment on this boat loan. Then immediately we hit our second menu and our PV button, and we can amortize that loan. So again, isolate one payment at a time. P1 is 1, P2 is 1, and then we simply arrow down. So then we can see the loan balance goes down to $14,651. The amount of principal that came out of that first payment was $348, and the amount of interest is $150. And then we could go back up and make the P1 2 and the P2 2 and fill in those values. So we can just keep going in that same manner. Mortgages, again, are the same computation. We're still using our time value money key. They are monthly payments, so our N is going to be in terms of months, our IY is per month. But we also may be given the amount that goes into escrow. So if any of you have ever bought a house, you've got to calculate your monthly payment to the bank to pay off the loan, but they're going to include this escrow amount. So the problem is going to give us the annual amount of property tax and the annual amount of insurance. We've got to add those together and divide by 12, because the key is we want to get that into a monthly amount. So then what we've computed as our payment needs to be increased by this monthly escrow average to cover our property taxes and our insurance. So don't forget about those. And then that is really our loan. So again, most of the chapter will use our time value money keys just like we did in our compounding interest chapters.